I mean, when you look at what's happening with the FX markets, they don't seem to be convinced that this is just about sort of, the bond, just about making the bond yield and the bond market smoother. They're seeing this as more hawkishness.
Well, I think it is a shock to the market, first and foremost. The market was not expecting this to unfold under Kuroda's tenure at the Bank of Japan. As you pointed out, he is about to exit stage left come April. So you have this sort of general sense and noise level rising that the Bank of Japan would eventually shift, but it would likely be under new leadership. And we do have this one-off tweak. It is just a lifting of the cap on those 10-year JGBs, as you indicate, and a strong indication he attempted in the press conference, I think, trying to maybe mute what they knew would be a very strong market reaction to any anticipation that this would be, the beginning, the starting pistol for something bigger afoot here. I think it will be eventually, but that will be under the new governor. So, he says this is not a rate hike. I think the market reaction begs to differ. It was a rate hike. The market wasn't anticipating it, but I think the timing was a bit clever and that the market wasn't looking for it. It comes at a time when there's not this huge pressure on the Japanese yen, which was mounting so viciously before when dollar versus the yen was trading up at 150. Here we are in the mid 130s when this move unfolded. So, and I don't think it necessarily has any feed-on implications for the rest of the other central banks. But of course, when you have a major bond market suffering a major shift, it does see some contagion, and we do have the legendary Japanese saver here with their savings sloshing around the world and looking for yield. It changes the maths a little bit, and maybe changes the complacency on funding in Japanese yen to seek yield elsewhere in the world. So a big sort of margin call maybe on some of these types of trades as well.
John, I want to hone in on those comments that we got from Governor Kuroda during the press conference, because to your point, you can kind of read it in both directions. He said specifically this change will enhance the sustainability of our monetary policy framework. It's absolutely not a review that will lead to an abandonment of yield curve control or an exit from easy policy. Is there an argument to be made here that the tweak is, in fact, a strategy for the BOJ to make this YCC a little more sustainable because they're in it for the long haul?
I think it's in a way, it's a clever way to say, look, we are capable of moving. It is, if this is where the Bank of Japan stops and global yields start to march higher again, the pressure will immediately go back to the Japanese yen if the assumption is, well, the Bank of Japan, this is all they can deliver and they're simply never going to change anything else. Just by having that element of uncertainty, I think it buys them a bit of leeway if we do see a fresh rise in global yield. So, he can reinforce all he wants to. I think the market is already learning not to expect or trust too much what the Bank of Japan is saying now from meeting to meeting, when so recently Kuroda was defending the existing policy, and it sounded like there was just no anticipation that they would change. So I think there is that element of just buying that uncertainty, have some optionality, or bringing the idea of optionality into the market so that you don't see that runaway pressure on the Japanese yen the next time around.
John, I guess the question is, how much of what we're seeing in the markets today is a one-off on a surprise move from the BOJ? How much of it is going to be sustained? We saw the yen strengthen against the dollar. Are we likely to see this trigger a sell-off in dollar assets, or is this going to be pretty short-lived?
Well, I think there's a stepwise reaction here, and we've probably seen the bulk of that. I don't see any need for a chaotic further revaluation of the yen higher if there is no follow-up move. So I think to get a sort of a sustained move trend-wise, you would need to see global yields starting to march lower again, because after all, Japan still does yield a very small amount after this change relative to other global bond markets. So, the stepwise reaction here could last, the week or less in the short term. And then after that, you've reset, okay, looking forward, where are bond yields headed? Where's the global economy headed? Are energy prices going up? That's also a vulnerability of Japan. Part of the reason that aggravated and drove the yen lower are yields back on the march higher again, or have we not seen the lows because we're heading towards some global recession? The latter being more yen supportive, whereas a rise in yields, again, I think pretty quickly starts to temper this move after what I think is starting to be a fair pricing at current levels of yields at around 130 in dollar yen, so 130.
Yeah, and worth noting that even though we're talking about inflation at decades highs over in Japan, it's still 3.8%, which is pretty moderate when you compare it to where the rest of the world is right now. John Hardy, Saxo head of FX strategy, good to talk to you today.